Hey guys, welcome back to my channel. Today is January 3rd, 2022, and I thought about doing a little bit of an exercise with you. We're gonna do this together, and basically, the purpose of this exercise is we're gonna figure it out if Tesla is a value stock or not. Just to basically investigate and evaluate if this is a good buying opportunity for those who have a long-term perspective for Tesla. All right, so we all know that the stock have been falling and falling pretty much. I mean, today they have a big drop of a little bit over 12% to 108. These prices are incredible. So it gives me the question of how is this basically putting Tesla as a value stock. So if we go back and we look not a 1 year performance, but a 5 year performance, we can see that the last time that Tesla was trading at this level was around, let's see, it is June 2020 or so. So let's face it, the company was in a very different situation back then. A lot had happened in these basically 2 or 3 years of company operations. So the fact that we are going back to those prices basically tells me there is a potential for Tesla to be a value option for most people now. So let's go right ahead and let's evaluate that option. Okay, so the first thing that you need to know is, and this video is again to calculate the intrinsic value of Tesla. So we're gonna use what is called the discounted flow model. So in this scenario, we are calculating the intrinsic value of the company itself. So the intrinsic value, just to give you a definition, is a fair value of the business, what the business is actually worth to us. In the theory of investment value, this is a wonderful book that I highly recommend. It is by John Board Williams. Basically, he says the intrinsic value of a stock, bond, or business is determined by the cash inflows and outflows discounted at an appropriate interest rate that can be expected to occur during the remaining life of the assets. So, in other words, let's put it this way, right? Because I really want you to be interested on this. Let's say Elon Musk come to you and he says, "I'm gonna sell you Tesla." And you say, great, I'm going to give you X amount of money. So what amount of money is that going to be? You have to know basically how much are you going to be willing to pay for this business. Well, one way to do it is you can go and you can buy all the shares of Tesla, right? Which will be the market cap, the price of the shares multiplied than the numbers of shares outstanding for the company. Another way will be to see if you purchase the entire Tesla company, how much money you're going to be making year after year, and then after a few years, how much money you're going to be able to get for this company if you sell it. So in other words, we're treating this company as if we go and we buy a small business, for instance. All right, so with that in mind, we need to calculate the cash that this business is bringing and how much it's costing for us to operate. And what we're really looking for is the free cash flow of the business. And that is a simple formula. It's basically the operating cash flow and the capital minus the capital expenditure. So how much money is coming in and how much money is going out just for us to operate the business. So like the definition says here, cash inflows and outflows. All right, so where do we find these numbers? Well, in order to do that, you can go to the Tesla website and you can look at the investors documents. Another way that I like to basically find all the SEC filings is by going directly to the SEC website. So you go to sec.gov. All the companies that are publicly traded basically have to submit their files to the SEC, and they keep it all very nice and organized for you to be able to access it here. So what you do is you just look for the company. So why don't we do that actually? So this is basically the main page. So if you go to sec.gov, this is what you're gonna find, right? Lots of information. And then over here in the upper right corner, you can see company filings, and all you need to type is just the ticker symbol of the stock for the company you are trying to investigate or find information for. So we can see here, if we type that TSLA, we have Tesla coming up. So we click on that, and voila, we have all of the filings for the company. I actually don't know how far they go, but I will assume that they probably go since the company went public. But anyway, so what we're looking for are, because they need to file all sorts of information, but we are looking for the annual report, which is also called the 10K report. And so if we click on this, we can basically see that the last time that they filed an annual report was on February 7, 2022. They're going to be filing another annual report very soon once they do their next earning call for the fourth quarter of 2022, and then they're going to file the annual report. So we don't have the latest annual report yet from them, but we can go and we can find that information once they file it. So if we click on that document, basically what you're going to have is this PDF file coming up. And sorry, I was looking at this earlier today. But yeah, so it's a PDF file. I will say for somebody who is not in finance or somebody who is not an investor, probably this is going to be a little bit intimidating, but and also because of the fact that it's so many pages and small prints and basically finance terms. It can be a little bit intimidating, right? We can see how many pages is this. It is over 100 pages, 116 pages or so. So, however, for all those basically young want to be investors, if you're looking to purchase individual stocks, so if you're not investing in a mutual fund or an ETF or some kind of well-diversified portfolio, if you're going for the picks of individual companies, I will highly encourage you to get familiar with reading reports for that company. So financial reports for that company. You need to know this type of information, specifically if you're just investing or even trading with a few stocks. You need to know what you're getting yourself into. And honestly, if you like the company, it's sort of going to be a fun exercise for you to go over and read all the information that they put in here, what the business model is, what are some of the risks, their financial information, things that they are thinking about doing in the future, and so on and so forth. So it's a very interesting read if you are truly interested in the company. So, all right. So, and what I like too is that they have the index here, and what you can do is just click on what you're looking for, the information that you're looking for, and you just jump in straight into that portion of the report. So we're gonna go here where it says financial statements and supplementary data. So if we click on that, we jump right into that portion of the document. And here you're going to find three main financial reports that pretty much any finance student knows about this. But if you're an investor, it is a good opportunity for you to also start getting familiar with this. They are called the balance sheet, where you have all the assets and liabilities. The second The second financial report that you need to be familiar with is the income statement, where you basically have, basically your income, as it is stated. And the last report that is very important to us, and this is what we're looking for, is the statement of cash flow. So this is where it tells you all of the cash that is coming in and the cash that is going out. All right, so finally we are here, and in all these small prints and small lines, we need to find basically the cash that is coming in into the business. And you're gonna see that the cash flow statement have three portions. The first portion is cash flow from operating activities, cash flow from investing activities, and then cash flow from financing activities. And again, after you look at a few cash flow statements, you're gonna see that they are all pretty much the same. All right, so on the cash flow of operating activities, we're gonna go to the last line here, and we're gonna look at this number here, the net cash provided by operating activities. And we're gonna see that that is 11,497. Now, keep in mind that all of these financial statements are in millions. They cannot obviously fit so many numbers here, so they just abbreviate that. And we have 11,497 millions. That is the cash that came in, and that is what is gonna be the first part of this formula here. All right, so we are 50% there. We found the operating cash flow, and I just put it nicely for you here. Net cash provided by operating activities, it is that number right there. And now we need to find that capital expenditure. Well, you're gonna find that also in the cash flow statement, and that's gonna be here under investing activities, and that's gonna be your purchase of property and equipment. And it says excluding finance and leases, net of sales. So basically that is the number that we're looking for, and you can see that that is a negative number, which makes sense because that is basically the outflow of cash. So that number is 6,482, and again that is in millions. So I put it here, I wrote it down, and now if we input that into the formula, we basically have that we need to subtract 6,482 from that 11,497, and that's going to be 5,015 millions, or in other words, $5.015 billion. All right, so just to take you back to earth and explain to you what this number is, this is the cash that it is actually brought by the company in a year's time. We're talking about 2021 here. And so they brought in $5 billion in cash. They can invest with that money, they can expand their R&D, they can bring new talent and use it for salary. That is basically the cash that they have generated, and they can use it to expand the business. Other businesses, they use it for dividends, etc. But that is a good chunk of cash that this business is bringing, just in my opinion. So $5 billion we're talking about. All right, so now what do we do with that number? Well, the next step is that we need to create, and I created it here, a small spreadsheet. And the reason for that is, well, we basically need to not only know or try to estimate the cash flow of 2021, which we already know the number. We need to estimate the future cash flow of the business. So in other words, if I purchase a business right now, you want to know how much that business is going to be making in year 2, year 3, year 4, and so on, right? If you imagine yourself, if you're purchasing a small business, you want to know approximately how much you can make in the future years, right? So this is why we have this column here. It is the free cash flow, and then if I put here 5.015, I'm just gonna keep it all in billions just for simplicity. we basically see that we have, well, let me step back one more step here. Okay, so we basically see that I have 5 billions here, 5 billions. Well, that doesn't make sense, right? Because we're expecting for this business to grow. I mean, it will be great if we can generate 5 billion every single year, or even a little bit more, since we're expecting that Tesla is going to grow, right? But at what pace this business is going to grow? And for that, we use a percentage growth. We call that growth, and I put it right here. Well, if the business growth at 10%, then those are going to be our cash flow year by year. And then on the last line here, we estimate the 10 times free cash flow. And I'll go over that in a little bit. But you can see that if you change this percentage, this is all in percentage, and we say this business is going to grow by 20%, then these are the numbers. Let's just say for the purpose of this calculation that we're going to grow this business at 30%, okay? And so in that case, we're going to be generating, so we generated 5 billion in 2021, 7 billion in 2022, 8 billion, 11, 14, and so on and so forth until 2030, that we generate 53 billions. And then what's going to happen, as we said with the example at the beginning, is, well, we're going to be generating, we're buying this business, we're expecting cash flow every year. And then at the end of a certain period, in this case, we're calling that 10 years, we're going to be selling that business, and we are looking for a multiple of 10. This multiple can be different, can be 20, can be less than 10. But for this purpose, we're just going to do a multiple of 10. And we can see that the number is going to be 532. So altogether, basically, that is the free cash flow that we're getting over 10 years. All right. So with that, we know that, 2030 is a few years from now, right? 8 years from now, 7 years from now, where we just started in 2023. So we do have to have something very important in consideration. And if you're studying finance, this is going to be one of the first concepts that you learn about. And that is the time value of money. And because of that, we have the second column here. And this is the discounted cash flow, meaning that any amount of money that we hold today is going to be worth less in the future. So if I take you here back to the browser, you probably are familiar with this formula, but if you're not, this is a wonderful, wonderful formula that is related to the time value of money. And basically, it says that the present value equals the future value times 1 over 1 plus the rate of return times the number of periods that we are calculating. So it basically, what you have to know here is that present value is always higher than future value, and that the rate that we're talking about has an impact on it, and so does the period. So those are the components that basically influence the present value of money. So if we go back to the spreadsheet here, I have another cell here called the discount, and I set that to 0. Well, basically, we're saying that every line is the same because we're not discounting anything. But we already saw that that is not correct. We need to discount the future value and bring it to the present value. Okay, so let's just say that a good rate that we can use is going to be 15%. And basically, another way that you can look at this is your opportunity cost. So in other words, how much you're expecting for this money to grow every year. And so if we look at 1 year, just to be an example, 2024, we're expecting 11 billion, right? But that 11 billion really has a value of 6 billion today. Why? Because we can invest that money and get 15% return year over year, and then that's going to be equal to 11 billion. So that's another way to look at that. So once we discount all of our cash flows, we have how much we're going to be getting year over year, because remember, we're paying for that business today. So the money today is not worth the same as the money in the future, so we have to discount for that. And then we also discount that terminal value. This is called basically the money, the big paycheck that we're going to be getting at the end once we sell the business. And the final step is basically adding all of these cash flows that we're gonna get year after year, plus the final payment. And what that's gonna basically give us is the current valuation. So we can see that number right here. We have a current valuation of 212 billion. Well, what if we play with this growth here? Because I want to see how this impact this valuation. If we say the business is only going to grow at 10% year over year, we have a $65 billion valuation. For Tesla, 20% give us $117 billion of valuation, where we saw 30%, and now we're going to try 40%. 40% give us a $379 billion of valuation. So you can play with this number around, and you can see really how much the growth that we're expecting for this company to have really impacts the valuation of the entire business. And this is why analysts, you always hear about how they are projecting the growth, and now you understand how important that number is. If we are talking here 40 versus 30, we're talking almost over 150 billion or so, or 100 and a little bit more, 180 billion or so of a difference in valuation. So this growth here that we are using is important. Okay, so for the purpose of these calculations, let's just say 40%. I mean, they have been talking in previous earning calls, if I remember correctly, that they want to grow at a pace of 50%. Yesterday with the delivery numbers, we saw that they grow their delivery numbers year on year by 40%. So for that, let's just use 40%. And I think that this discount of 15% is okay for us to use. But you can also play with this and look at how that impacts the valuation. All right, so moving on. Now we finally have our number. We can see that the current valuation of Tesla is $379 billion. All right, but there is one more step. And by the way, this number here is very similar to the actual market cap of Tesla right now, and the number that we have been getting in the previous few days. Now that the stock is trading at a very low price compared to what it was before. All right, so there is one more step here, and is that we need to add the cash that they have in hand. So I call this valuation plus cash. And if we go back to basically what that's going to mean is that we need to add the cash and cash equivalents and the short-term marketable securities. In other words, going back to the example of buying a small business, think about if you're buying a small business, you're also buying or most of the time you're buying their bank account, and whatever money is in the bank account you're also buying with. So say if you're buying a laundromat and that laundromat have $25,000 in their bank account, you're probably getting all of that as well. So you need to have that in consideration. All right, so that number, you simply can find it in the balance sheet. So if we look under assets, it's going to be the cash and cash equivalents and the short-term marketable securities. And I added that for you. It's a little bit over $17 billion. So yeah, it's $17.5 billion plus $0.13 billion. So that is 17,707 millions of 17.7 billion dollars that they have in cash. This is cash that they can access right away. Basically, it's cash available to them. Like I said, since we are calculating the value of the company, then we need to have this in consideration. All right, so if we add that, and I included that in the formula here, you can see just 17. Maybe I can do 17.7 just to be more accurate. That's going to be 397 billion. So we are saying that if we're expecting that this company growth at a 40% year over year and at a discount of 15%, to calculate the present value, we're saying that this company is valued at $397 billion. Okay. And so we can go to Elon Musk and we can say, this is the offer that we're giving you for Tesla. Okay. And it's going to be a fair offer. And if you think about it, most people don't think about it this way. But every time you are purchasing a share, you're basically buying the business. Now, are you paying more or less of what the business is worth? And that is the goal of this entire exercise, right? Even though you're not buying all of the shares outstanding, most people are not. Most people just buy a few shares. You have to know if you're overpaying for the business or if you are paying what the business is actually worth. All right, so with that, we need to basically find the valuation per share. And I already calculated that here, but I want to show you because another number that you need to know here is how many shares outstanding they have. And I just want to show you real quick where you can find that, because most people just look over in the internet to find that. But that is also in the financial documents that they file. You most likely are going to find it on the first page of every report of a company, every annual report, and it's right here. So they say as of January 31st, 2022, they were $1,033 million approximately in shares. And these are common shares or common stocks outstanding. Now, let's remember one thing here. They did, since this date, they did a 3-for-1 split of the shares. So that means they increase the number of shares. That doesn't have any impact on the value of the business. They just basically divide the pie a little bit more. So you have to multiply this number times 3. And if we think about a number of shares, that's going to be around 3,099 shares. So let's just round it to 3,100 million shares, which is 3.1 billion shares. So what I did, and I want to show you that right here, is to find the valuation per share, I just get the valuation of the whole company, which is in billions, and I divide it by the number of billion shares that is, which is 3.1 billion shares. All right, so that gives me a final price of $128 per share. So there it is. That is the number that we're looking for to see if the stock is overvalued, undervalued. If it is undervalued, how much undervalued it is. If we go back to Seeking Alpha here, we see that the stock closed at $108 today. And we are saying with all of this calculation, we are saying that a fair value for the company right now is $128 per share. Now, one more step still. When we do all of this calculation, of course, we're making a lot of assumptions. We're making assumptions about the growth, we're making assumptions about this multiple here, we're making assumptions about the discount. We're making a lot of assumptions. So there is one thing in value investing that they teach, and actually Benjamin Graham, who is considered the father of value investing, and actually Warren Buffett and Charlie Munger, which are two of the most well-known value investors, among others, but these are the two that I admire the most. They actually learn from this person, Benjamin Graham here. And every time that you read about value investing, and you look at that discounted cash flow exercise that I just showed you, they also talk about a margin of safety. And what that means is basically, even though we have calculated this value per share that we are willing to pay, we also want to go a little bit lower just to have a little bit of a buffer, to say the least, in case anything happens in the future for which we have not accounted for. If we were a little bit off on our growth, if we were a little bit off on the discount rate, given economic conditions, if we were off on anything here, right? We want to give yourself a margin of safety. And this is how, basically these people were able to make so much money over time, because they always give themselves a margin of safety. Warren Buffett always wanted to buy good companies, and not, pay a good price for that company. So even though he might be wrong on a few cases, he still overall is good, and that is how he have been able to grow his wealth so much, being that he is a billionaire now. So anyway, so the margin of safety that we're calculating right now is 25%. Now, in margin of safety, you can say, well, 25% is low, or is high, depending on your risk tolerance here. Most people use the 25%. I've seen some margin of safety of 30%. Other investors are looking for that 50% margin of safety. They are not going to buy a stock unless it is undervalue, and they also on top of that have a 50% margin of safety. So those are, if you can find those opportunities, I will say, you're going to be winning pretty much every time, because 50% is 50%, right? So anyway, so we're calculating 25% margin of safety here, which means we are saying, well, we are willing to buy the stock at 20%, 25% less of what the fair value is, and that is $96 per share. All right, so with that, I will say we are not far from this number. I mean, I don't want to see the stock dropping to that number, but if we get to that $96 per share, we're definitely at a good 25% margin of safety, considering everything else is accurate enough and we are good with those assumptions. You can build this table. Let me know in the comments if you want to get access to this spreadsheet. It's pretty easy to build, but if you want it, I guess I can put it out there for people to use and to play around with. But I just want to show you, the valuation that I came out with these assumptions, valuation of $128 per share. And if we're considering a margin of safety, that is going to be $96 per share. So yeah, I will say we're getting really close to the number. Like I said, I don't want for the stock to drop anymore. However, if it continues dropping, I can see how this is going to be viewed as a great value opportunity just because of all the exercise that I show you and the growth potential that Tesla still has. Anyway, just let me know in the comments what you think about this exercise here. You know, one goal of my channel is to be able to educate investors and sort of share the knowledge that I have acquired year over year. And now that we are getting in these market conditions, in the economic conditions that we're getting, 2023 is going to be definitely a recession year, and you're going to have a lot of options to buy and a lot of good companies at a very low prices to buy, and you need to be able to evaluate the opportunities, and don't just go and say, oh, this, I like this company, the stock is low, I'm gonna buy it. No, run the numbers on it. See how much potential for upside you have. Really get into calculating the numbers. I think that is a great opportunity for people. I mean, I wish I would have this opportunity, a few years ago. But for a lot of people who are getting into investing in the market, specifically this year, man, they're gonna be great in 5 years, 10 years from now, because pretty much, unless the company is completely trash, they're gonna be in a great position 5, 10 years from now, with these low prices. So yeah, I guess that's it for now. Let me know if you like this type of content. A little bit of a long video, but an important exercise. And once you start learning about these tools, it's going to be so much fun to go and evaluate other companies, especially if there are companies that you have been looking into investing a long time ago. With that, thank you so much for watching. Please click like and subscribe if you like this type of content. Leave me a comment to see if you agree with this assumption here, or what do you think about the current Tesla price. I really like to hear other people's opinion on it. And yeah, I guess with that, I will see you in the next video. Thank you so much, guys. Thank you, and I will see you soon. Bye bye.